Hey guys, this is Jordan. Today we're going to talk about how to get money out of your S-Corp. So let's just say you're 100% owner of your S-Corporation and you're like, I want to take some money out of my business and pay myself because I have rent, I have a car payment, I have a cell phone bill. I need some of this money to pay for my personal expenses. To you, the money looks all the same. You make a simple transfer from your business bank account to your personal bank account, right? Or you write yourself a check. Like, there's a bunch of ways to do it. But in the government's eyes, if you're an S corporation, not all that money looks the same to them. There's two categories in an S corporation. You've got profits or distributions, that's the same, or you have payroll or salary. And in the government's eyes, how these are taxed looks totally different. So while it looks like just a dollar coming to you, it depends on how you categorize it. That's going to drive how it's taxed. So let's just look at both of them. If it's a salary, if you're on a payroll, and you have to be on payroll as an S-Corp owner, you have to have some portion of your money that you earn tagged as, okay, you're paid this because you have labor that you put into your business, right? And then you have profits or distributions, and that's just like, oh, you're just a great business owner, and so you have a profitable business and there's money left over at the end of the day. So let's talk about how they're differently taxed. So salary, you got income tax. You got income tax on everything. Income tax on your salary, right? But you also have to pay payroll taxes on your salary. And that's gonna be 15%. FICA tax, self-employment taxes, you've probably heard a bunch of those terms. It all means the same thing. You can just think about it as 15% is the tax for your payroll. And then you've got your marginal income tax rates, which that depends on how much money you make. Now let's go over to the profit side. You just have income tax. So you can see pretty quickly, if you've got money coming out of the business to yourself, you automatically have an incentive to say, well, it's all profit because I don't want to pay that 15% on it. I just want to pay the income tax. The government says you have to pay yourself a reasonable compensation for your work, and that they mean by the salary. So they would say, okay, you need to pay yourself a salary that is comparable to what you would have to pay someone else to come in and do the work for you. And that portion needs to be your salary. So the example I always use is you make $100,000 to your bottom line at the end of the year. You have to divide up that $100,000, some of it to salary, some of it to profit. So depending on how conservative or risky you are as a taxpayer, you can either do 30,000 salary, 70,000 to profit, or play around with whatever numbers work for you. But you can see pretty quickly, the lower your salary number is, the lower your 15% tax bill will be. But that kind of sums up how you get money out of your S-Corp. And it's not as simple in the government's eyes as, well, I just made a transfer from the business account to the personal account. So I just wanted you to know how to structure it because there is a lot of planning that can go along with your owner's compensation. So make sure you're communicating with your CPA to know, okay, are we really putting a reasonable amount as my salary to make sure I'm protected from audit? Or the vice versa is, am I putting too much of salary and am I overpaying in those self-employment taxes? That's a good conversation to have with your CPA if you are an S-Corp. So thanks so much for watching, guys. I will see you soon.